Here is why today's stock market volatility matters right now. The S&P 500, Nasdaq, and Dow paused after a surprise surge in U.S. GDP growth rattled investor sentiment. At first glance, the indexes held steady. S&P 500 edged higher, but underlying dynamics suggest a shift in risk appetite. Let me break this down. The key driver? A stronger-than-expected GDP report, which trimmed expectations for near-term interest rate cuts. Markets had priced in aggressive easing amid weak economic data, but this rebound signals resilience. The Federal Reserve's next move now hinges on balancing inflationary pressures against labor market strength. This isn't just about numbers, it's about global positioning. A hawkish pivot could pressure emerging markets reliant on dollar flows, while bolstering U.S. corporate earnings potential. Meanwhile, commodities like gold and oil saw mixed reactions, reflecting divergent views on inflation risks. For long-term investors, this underscores a critical juncture. If growth persists, policymakers may delay rate cuts, keeping borrowing costs elevated. That's a headwind for equities, but supportive for defensive sectors like utilities and healthcare. Conversely, a soft landing scenario could reignite speculation around fiscal stimulus. So what does this mean for traders? Short-term volatility will persist as participants recalibrate positions. Focus on sectors sensitive to rate sensitivity, tech and consumer discretionary, are vulnerable to repricing. Conversely, industrial and energy stocks may benefit from renewed confidence in economic momentum. If this analysis was valuable, subscribe for more institutional insights. Link in bio.